or at 80.90. Then we have that third contract at 82.90. One of the things about that contract, as you'll note, is kind of now we've exceeded some previous highs. We're in kind of a territory here where it might be a little bit more of a gamble to hold and wait, because we're now approaching some resistance that could be fairly significant. Now, if we held on to that third contract and we looked at it on, we could say that we're going to hang with it as long as we can, take advantage of the move and let it go where it will. On this particular day right here, March the 2nd, the predicted low was 81.72, so that would be mean our low, our stop rather, to get out would be at 80.72. Now it takes a little while for that to happen. It doesn't happen immediately, but in case it turns down, we're prepared for that market to go on down, and it does kind of take us out right at this particular point here. Now here's a situation that, as I said before, there are good points about trading hogs, and there are some bad points. We have a little choppy type of situation. There are a couple of trades in here that could have been made, could have gone back and forth, and it would have gotten you in and out. So you would have had potentially a couple of losing trades, where you had the situation of this candle where you might have gotten short. You would have been out immediately on the like a couple of days later on this particular candle. So there will be times when you're going to have these little gyrations that go back and forth. On this longer signal, on this candle that we have here, you can see that the market then starts to move up, and we get this big candle here. Now the question becomes, would you buy with the price so close to the previous highs and near that? And at this point, it might make more sense, in your opinion, to sell than it would be to buy. So you might be a little reluctant about being a buyer when we approach the highs. You want to make it prove itself and see what happens first before you get into the market. Now let's say that in this particular case on March 23rd, we have another situation where the market, it has made its little run up, which is a nice thing to have. You always kind of like to have either a correction or a little run up, because the markets will alternate between a running type of a situation, a trend, and then they'll do some correction or some sideways action, or they'll maybe even make a little counter move, and then the next move will unfold. So you kind of want to have that type of a situation, set up a trade that you might be looking for. So on March 23rd, we had this candle that we had right here where it starts to penetrate the downside of the predicted low. Predicted low at that day, 82.22, and so that means that at 81.22 we would sell that contract, and we it takes a little bit of time. It takes the next day before we get in, but we're in at this particular area right here, 81.22. Now again, we can set up our profit targets. You can do what you like. You can if you look at our profit targets, as we said before, of $2, we would then have a profit target at 79.22. This particular target was hit on March 26th, was report day, Hogs and Pigs report day. Now the question here is, going into a report, it happens 4 times a year in the Hogs and Pigs report. They have some notoriety for pulling some surprises and causing some sharp moves. Are you going to be involved in the market at that point, or are you going to be out of the market? It's probably a better situation going through a report. You have to sit on the sidelines. Again, this happens in the hogs and 4 times a year. So it's probably one of those situations where discretion is a better part of valor, or whatever it says. You might want to get out. In the case of Hogs and Pigs, know when that report is coming. It's not like you're going to see some big surprise, military attack or something like that. But you may have a philosophy of sitting out through reports. In this particular case, we'll say that you decided that you were going to stick with the market. Remember, you are out with the 1 contract, so you have 2 contracts left. Had you stayed with that report, you would say, okay, I am going to get out. I'm going to set my stop above that predicted high, and I'm going to be out. The problem that you have in this situation, as I said, was this limit move. It shot up. It was at, a 3-point limit up, virtually no trading. You were locked in, and if you were in that position yet, in this particular morning, the open was right around in this vicinity right here at 82.40. If you were in at 82.40 and you had two contracts, considering where you got in, it means that you would have lost a little under $1,000 on those two. But it's the type of thing that happens when you trade a market like the Hogs and Pigs report, because all of a sudden they have some news that comes in and it totally changes the complexity of the market and the way it looks. So you always have to be aware of that as a trader. We're going to go back and look at the cattle contract just to show you a little bit about what it looks like. We're not going to go into a whole lot of detail on cattle because we don't have a lot of time, but just to give you a kind of an impression here of the cattle market. Now we're back to our June, and we're going to go to our cattle market right here. We're using June. You might wonder why aren't we using April as a general policy. I don't like to be trading a market that's coming into delivery month as we would be with April today. So I'm looking a month ahead already, and I don't want to get involved. I don't want to, have these these rumors that you hear about somebody dumping a load of cattle or hogs on your front lawn. I don't want to get involved in any kind of thing like that or involved with the details. The cattle market, we had a somewhat similar situation in that we had the market go in a longer term uptrend. We have the double bottoms right here, right around 83, 84. The market shoots up. It approaches $100 contract. This shows you a 9-month contract. Let's skip down just to see what it looks like as just a 1-month contract to see what might have happened. You have the overall view in mind, but you can see that as this market moved up, there were a number of different breakouts where you potentially could have gotten on board where it moved above the predicted high. Then when you do get to the top, you have a candle right here that needs to be, you need to give it a little attention because this is a doji top where the market opens and closes at almost the exact same point. It rises above it. Traders reject that price. It closes about that same area. It indicates a lot of uncertainty that's going on. Secondly, you have the approach of $100. Kind of the previous contracts highs were above $100, but $100 is kind of one of those psychological barriers that you have to deal with, kind of like in the oil market where you get a $100 price, and that's a psychological factor that you have to take into consideration. So like with hogs, you could have been short in this particular contract and gotten a little ride in the downturn, but if you were looking at the more current time, when you look at what's happened in the last day, yesterday, you would find that the market then shot above the predicted high, and so you would be at least out of that position. You'd had a small loss. Now the next thing you're going to be doing is probably watching for a setback that